Hello everybody and welcome to another episode of the Reside Daily Bite. I'm your host, David Doucette, and we have a nice windy sunny day here in Southern California. So if you hear any noise, any windows rattling, it's Mother Nature. I'm not sure if any of that will be picked up by the microphone, but if you hear it, have no fear. It's just Mother Nature bringing us some very strong winds. The article I want to talk about today is getting a loan will be pricier, and if you remember or if you've been following us on episode 22 of the Daily Bite, I talked about interest rates will rise, but by how much and when. And this talks a little more about that interest rates, the interest rates going up. They talk about the Federal Reserve playing a key role in keeping the cost of the borrowing so low. And they've been keeping the Fed funds rate basically near 0% since December 2008 as they work to really spur the lending and economic activity. But now they're saying as the economy heals, the rate is sure to come up, as will the cost of loans. Let's talk about what's happening right now. The 30-year fixed rate mortgage reached an 8-month high last week, averaging 5.21% according to Freddie Mac's weekly survey of conforming mortgage rates. So several times in 2009, mortgage rates dipped below 5%, considered to be record lows thanks to the Federal Reserve's help. So what we saw in 2009 was the mortgage rates below 5% for a lot of the time. Now, it's important to note this is historic record lows. And even the 8-month high of last week, 5.21%, is still a really low interest rate. And we know it can't stay there forever, and we know it's going to be going up. And again, by how much and when, that's what we don't know, but this article talks about a little bit about that. Michael Frantantoni from Mortgage Brokers Association says throughout most of last year we were right below or right above 5%, which is really an extremely low rate historically, which we just talked about. He has been predicting mortgage rates would rise, maybe even reaching around 5.8% by the end of this year. And experts predict the rates will range around 6% in 2011. So this year, next time, what they're saying is we're probably going to be around 6%. And that seems to echo some of the other things I've been reading and some of what the other experts have been saying. So these historically low rates that we've been seeing are going to soon probably be a thing of the past. Now, with that said, 6% is still a low interest rate. But what the article says is mortgage rates can really impact consumers by limiting what they can pay for a home. And they give a good example that I want to share with you. Take the $165,000 median home price of existing homes sold in February. So $165,000. A buyer with a 20% down payment would pay just over $725 a month in mortgage payments for a 30-year fixed at today's rate. If you raise that by a half a point, that same buyer would only be able to afford a home worth $156,000 to keep payments near that $725 a month level. So it reduced the purchase price, or the ability for the purchase price, by about $9,000. So just that half a point increase in the interest rate. And then it also talks about credit cards. I'll touch on this briefly. The average credit card rate rose to 14.7% last week from 12.55% from 6 months ago. And we've all seen this. I know I've seen it, and credit card companies are changing their terms and conditions. And they say it's going to keep going upward a bit because credit losses aren't going to improve for the banks until unemployment heads down. And interesting note, while new credit card laws passed by Congress in the past year make it more difficult for banks to raise interest rates in several ways, they won't touch hikes in rates based solely on financial index one common index used is the prime rate, and we've all heard that prime plus X is at 3.25%, which is a low, and that's expected to increase. So when that prime rate increases, so will the interest rate on the credit card. And then they also talk about auto loans. Bright spot could be auto loans, which have been record lows, and auto loans average 4.4%, much lower than 7.3% back in March 2007, and they expect the auto loans to stay low for quite some time. So that is it. Again, further proof or evidence that the general feeling is interest rates are going to rise. If you have any questions or feedback, 1-800-476-5579, or you can email feedback@residerealestate.com. I'd love to hear what you guys thought of this episode, or if you have any other questions you'd like me to address, or if you have any ideas for future Reside Daily Bites. My name is David Doucette, and thank you so much for checking us out today.